Welcome to Breaking News to Trading Moves. Welcome to the debate. 90% of retail traders fail. But here's the counterintuitive part. They do not fail because they are bad at math. And, well, they do not fail because they do not understand the news.
Right.
They fail because they are fighting a war on two fronts. They are fighting the invisible mechanical structure of the market and, the biological wiring of their own brains.
Yeah, and that biological wiring is just relentless. I mean, you step into the market thinking you are executing a rational business plan, right? But the reality is you are constantly battling your own instinct to survive.
Completely.
It is an environment designed to trigger every human vulnerability we possess.
Exactly. Which brings us to the core tension we are exploring today. We are looking at the origin of a trader's edge. Does consistent market success stem primarily from psychological mastery and contrarian behavior? Or does it come from strict adherence to statistical probabilities and structural market mechanics?
Right. We are looking at whether conquering human nature is the primary requirement for success, or if exploiting objective mathematical edges and structural realities must take precedence over everything else.
And just to lay our cards on the table, I represent the view that the ultimate edge is psychological. Consistent market success comes down to mastering human emotion and embracing contrarian behavior to navigate an environment driven entirely by irrationality. The math only matters if the mind allows it to function.
And my perspective is that, sure, psychology is the prerequisite, but the actual edge, the engine that generates profit, is strictly structural and statistical. Success relies entirely on exploiting mathematical probabilities and understanding the mechanical footprint of capital.
Well, I think without mastering yourself first, you are lost.
But without that structural advantage, psychological discipline just turns you into a highly disciplined loser. You can be perfectly calm while you slowly bleed your account dry.
I mean, let me frame my position by examining how the market actually functions. Market prices are determined not by the underlying economic environment, but by the hopes, fears, and expectations of the participants reacting to that environment.
Sure, emotion plays a part.
It plays the biggest part. Humans are inherently wired to fail in the markets. Normal behavior is what leads to losses for 80 to 90% of retail traders. Achieving an edge is entirely about overcoming our emotional reflexes.
But you need a system. Hang on, let me finish. I am talking about the primal urge to buy high when the news is overwhelmingly positive, or the panic that forces you to sell at the exact bottom of a decline. We must accept that there is no holy grail indicator. The only true edge is mastering the self.
Okay. I come at it from a very different way. I agree that emotional control is necessary. I mean, you cannot execute a plan if you are completely paralyzed by fear.
Right.
However, I argue that the foundational edge is strictly mathematical. An edge is very clearly defined. It is simply that one outcome is more likely than another over a random distribution of wins and losses. That is it.
Just numbers on a screen.
Numbers that dictate reality without a proven structural advantage, such as understanding liquidity pools, stop hunts, or the mechanical reality of price, time, and volume. You have nothing to execute.
I completely disagree that it is the foundation.
You can possess the emotional control of a monk. You can sit completely undisturbed as your capital fluctuates, but if your strategy lacks positive mathematical expectancy, you will still fail. The math is the business.
Okay, I see why you think that, but let me give you a different perspective on these so-called objective structural advantages. The reality is that technical charts are overwhelmingly deceptive.
Deceptive? How so?
We suffer from a cognitive phenomenon called apophenia. This is the human tendency to see patterns in completely random data. We look at a chart after the fact. We draw a diagonal trend line connecting a few arbitrary peaks or identify a head and shoulders formation, and we convince ourselves we have found a reliable architecture.
It is not arbitrary, though.
It is an illusion. We see a trend line because our brains crave order, not because the trend line possesses actual predictive power. This is why systems based on rigid mechanical rules like moving average crossovers might look brilliant in a steady, slow-moving trend.
Because they capture the momentum?
But they completely collapse when market volatility transitions into choppy, unpredictable, sideways price action. The human brain projects an illusion of safety onto random chaos.
I am sorry, but I just don't buy that. Let me tell you why. Objective market structure is not a psychological illusion generated by our brains craving order. It is the mechanical footprint of capital moving through the system.
A footprint that changes whenever the crowd gets scared.
No, consider the mechanics of institutional order flow. Large institutions, banks, and hedge funds cannot just click a button and enter a massive position. They have to engineer liquidity. Imagine a massive fund needs to buy 1 million shares.
Okay.
They cannot just submit a market order for 1 million shares. If they do, the price skyrockets halfway through their order, and they ruin their own entry price. This is called slippage. They need to find 1 million willing sellers all at once.
And how do they magically conjure 1 million willing sellers?
By exploiting mechanical thresholds. They let the price drop just below a major obvious support line. Retail traders universally place their stop-loss orders right under that exact line.
Because they are predictably fearful.
Yes, but a stop-loss is just an automatic sell order. When the price crosses that threshold, a cascade of automatic sell orders is triggered. That sudden flood of sell orders provides the exact liquidity the institution needs to absorb and build their massive long position.
So they are hunting the retail traders.
When a market drops, triggers those stops, and immediately reverses, that is not apophonia. That is a structural stop hunt. It is the mechanical reality of how big players absorb liquidity.
Wait, I have to stop you right there. You are making it sound like these institutional footprints are an infallible law of physics.
Over a large enough sample size, they practically are.
But if these structures are so objective, why do heavily back-tested quant-level systems routinely collapse in real-world conditions? Think back to the market reaction to the Kuwait invasion in 1990.
That is an extreme outlier event.
But it happens. The night the invasion began, the Dow gapped up over 75 points at the open. A mechanical system based purely on structural footprints or moving averages might have triggered a signal to enter or exit at a specific price. But reality dictated that it was physically impossible to execute anywhere near the previous close.
Sure, gaps happen.
The objective structure completely broke down in the face of sudden human panic and geopolitical chaos. Where is your structural math when external reality shatters the chart?
That exact scenario is why the edge is statistical, not predictive. A structural trader understands that an edge does not guarantee the outcome of any single trade.
But it destroys the account if you are on the wrong side of it.
The Kuwait invasion is a perfect illustration of the principle that anything can happen. A single outlier event, a geopolitical shock, or an overnight gap does not invalidate the structural mechanics of the market over a sample space of thousands of trades.
Thousands of trades? Most retail traders do not survive 100.
Think of it like a casino. A casino does not know if the next spin of the roulette wheel will be red or black. And honestly, they do not care. They just know they have a mathematical advantage over 10,000 spends.
Right.
An objective edge means that over a random distribution of wins and losses, the mechanics of liquidity and order flow will yield a positive return. Retail traders fail because they evaluate their strategy on a trade-by-trade basis. They abandon their system after one geopolitical shock because they do not understand that validity is proven over a massive series of executions.
But if we acknowledge that anything can happen on any given day, then the real advantage comes from how we process external information and exploit the herd's predictable reactions to those chaotic events.
Exploit the herd?
Yes. Building on the unreliability of technical patterns, the true edge lies in contrarianism. The herd is almost always wrong at the major turning points. Let us look at 1929.
Ah, the classic example.
You had Irving Fisher, an eminent Yale economist, declaring stocks were at a permanently high plateau. Jesse Livermore, a legendary market operator, stated the decline should go no further just before the market collapsed completely. When the consensus is that universally unified, it is the ultimate signal to take the opposite position.
That is a compelling argument. But have you considered that trying to outsmart the herd is just another form of prediction? You're trying to guess the top.
How so? If the crowd is uniformly euphoric, history dictates a reversal is inevitable because there is simply no one left to buy. Look at thin read indicators.
What is that?
These are subtle signs that the consensus has reached a fatal extreme. Years ago, a major institutional research firm completely dropped its coverage of Campbell's soup right as the consumer sector was expanding.
And you think that was a signal?
What did that mean mechanically? It meant institutions had abandoned the stock entirely. It was completely out of favor, thoroughly discarded. That extreme bearish consensus perfectly preceded a 900% appreciation in the stock's value.
I understand the logic, but trading based on that is incredibly dangerous.
It is exactly how you find the turning points. Another perfect example is the magazine cover indicator. When a financial trend finally makes the cover of a general-purpose mainstream publication, it means the very last participants have finally bought in.
So wait, you were trading based on grocery store magazines now?
Think about the mechanics of that. For a complex financial trend to become mainstream enough to sell magazines at a grocery store, every single person who could possibly be convinced to participate has already committed their capital. The pool of potential new buyers is completely empty.
That is quite an assumption.
There is no capital left to drive the price higher. Exploiting that human predictability is the ultimate edge.
I'm not convinced by that line of reasoning, because trying to be a contrarian still requires predicting a reversal. Isn't it safer to adopt the mindset that every moment in the market is unique, rather than trying to outguess the herd?
But the herd always leaves a footprint.
Yes, a magazine cover might signal a top, but the famous Birth of the Bull cover actually preceded a massive long-term rally. Contrarianism often leaves people stepping in front of a speeding locomotive, just because they think the herd must surely be running out of steam. It is far safer to trade the news structurally.
What does trading the news structurally actually look like in practice then?
When a major news event breaks, like an unexpected inflation report, rather than trying to guess if the crowd is wrong or right, a structural trader looks at how the news physically drives liquidity.
Okay.
Does the sudden influx of volume cause price to sweep those external liquidity pools we discussed earlier? Does it trigger the stops below support, absorb that liquidity, and then immediately reverse back into the established range?
So you are still waiting for a reversal.
But I am trading that structural reaction, which is mathematically sound. You are letting the news create the volume, and you are trading the mechanical footprint of that volume. Trying to outsmart the consensus is just ego.
That is a compelling point, though. I would frame the difficulty differently. The reason contrarianism feels like stepping in front of a locomotive is because it demands an excruciating tolerance for psychological discomfort. Well, we agree on that. Trading is uncomfortable.
And that brings us to the actual execution phase of trading. Managing a live trade is essentially an exercise in enduring psychological pain. If you are listening to this and you have ever watched a trade go against you, moved your stop loss further down because you desperately hoped it would bounce back, well, you know exactly what this feels like.
It is a terrible feeling.
The normal human behavior is to take profits quickly to feel safe and to hold on to losing positions, hoping they turn around.
Which is exactly why structural rules must override feelings.
But executing those rules requires defying human nature. You have to add to a winning position when every biological instinct is screaming at you to cash out and secure your safety. You have to refuse to set arbitrary profit targets, precisely because doing so is the only way to see what the market will give. I don't know about refusing profit targets entirely, but
sitting through massive, fluctuating, unrealized gains without giving in to the fear of losing them is not a math problem. It is an exercise in emotional endurance.
I do not disagree that execution is uncomfortable, but I reframe this entire execution strategy as a mathematical necessity rather than purely psychological torture.
Oh, it is definitely torture.
Adding to winning positions and cutting losses instantly is not about proving how much mental pain you can endure. It is about mathematics. It is about asymmetrical risk-to-reward ratios. You scale into trades and adhere strictly to stop losses, meaning you never ever average a loss, because those are the structural tactics required to maintain a positive expectancy.
Averaging a loss is akin to trying to put out a fire with gasoline. It is a purely emotional response to pain. But by refusing to set profit targets, aren't we admitting that our structural math is entirely blind to the future?
Not blind, just acknowledging probabilities.
If the math is so reliable, if the liquidity pools are so objective, why can't the formula tell us exactly where the trade will end? Refusing to use a target requires the psychological discipline to sit through the unknown. That is entirely behavioral.
It is admitting that the math is blind to the outcome of this specific trade, and that is the exact mindset required for success. We do not need to know what will happen next to make money.
Right.
We use structural elements, like previous daily highs or established volume nodes, to frame the entry and the invalidation point of the trade, but we let the broader probabilities play out. The refusal to set a hard target acknowledges the random distribution of outcomes over a massive sample size.
But you still have to manage your mind to stay in the trade.
Yes, you must manage your mind to stay in the trade, but the profits themselves are derived entirely from the structural reality that trends go further than human intuition expects. The discipline is purely in service to the math.
Which leads us to a fascinating synthesis of our two perspectives. As we conclude, I maintain my stance that the market is, at its core, a mirror of human frailty. Success demands an unnatural level of objectivity and emotional detachment.
Unnatural is definitely the right word for it.
You have to divorce yourself from the daily gossip, the financial media, and the constant barrage of opinions. You have to accept that your own brain will trick you with apophenia, and that your natural instincts to seek safety will almost always lead you to ruin. The ultimate edge is the total conquest of your own behavioral reflexes.
And I maintain that while a disciplined mind is non-negotiable, it is only the vehicle. The actual profits are extracted by respecting probability, understanding structural liquidity, and rigorously executing a mathematical edge.
A beautifully designed vehicle, though.
Sure, but without the math, discipline is just organized failure. You can be the most stoic person on earth, but if your system lacks positive expectancy, you will slowly bleed your capital to zero.
Yet we find strong convergence on several fronts. Both of us completely agree that relying on experts or searching for the mythical holy grail of a perfect, fail-safe system is a destructive trap. The experts in 1929 proved that pedigree and academic brilliance do not protect you from market realities.
Absolutely. And we also agree that the reason the vast majority of retail traders fail is because they lack rigorous methodology. They trade based on excitement, rumors, and panic, rather than approaching the market as a systematic, probability-driven enterprise.
There is immense value in viewing market success through both lenses simultaneously. The ultimate insight here is that structure and psychology are not actually two entirely separate things. A technical chart is really just a two-dimensional map of human anxiety and greed.
I like that definition.
When you execute a mathematical edge, you are quite literally monetizing someone else's emotional breakdown. Math is the weapon, psychology is the armor.
That is an excellent way to frame it. The interplay between human emotion and structural mechanics is what creates the market itself. Every order flow chart, every swept liquidity pool is a mathematical representation of a behavioral decision made under pressure.
Exactly. It brings us right back to our opening thought. When you step into the market, you must recognize both the invisible architecture and the flaws of your own perception.
The real challenge is holding both realities in your mind at the same time, without letting the chaos break your rules.
That is the question every trader has to answer for themselves. Thank you for joining us on this intellectual journey. Until next time, keep questioning the reflections.